So welcome you all for the Alternate Universe episode 6 is 𝐬𝐞𝐜𝐥𝐮𝐬𝐢𝐯 and Analyst Famous Bazaar. So topic for today is asset allocation alternate space. With no delay, let me welcome the guest for today, Mr. Saurabh Jain. Saurabh Jain is the Managing Director and Head of Wealth Management Standard Chartered Bank India. Saurabh leads a wealth management business covering investments, insurance, foreign exchange, equities, and wealth leading products. He's responsible for driving assets under management, revenue growth, product innovation, governance, and strategic digitalization agenda for the business. Saurabh joined Standard Chartered Bank India Limited as a CEO in October 2019 and went on to head the deposit products and client acquisition with bank before taking over the head of wealth management India. He has also held various senior roles in Citibank India and HDFC Bank prior to joining Standard Chartered. So HDFC Bank is common thing between us. And Saurabh has also done his Bachelor of Commerce at St. Xavier's College, Calcutta, and also a CA holder. Moving on to Mr. Vikaas and Sachdeva, who's a no new face to us. He's an industry stalwart with over 3 decades of experience in asset management business. He's currently managing a director of Sundaram Alternates Assets Limited. Moving on to the next person on the table is Mr. Madanagopal Ramu. He is the head equities and fund manager with over 15 years of experience in the Indian financial markets. He currently manages the asset under management around 3,400 crores across PMS and AF platforms at Sundaram Alternates. So, with no delay, let me give the podium to Mr. Vikaas and Sachdeva. So, over to you.
Thank you so much, Akshara. I hope I'm audible to everybody. Welcome, Saurabh, to this show. It's really a privilege to have you here. And indeed, it's a privilege to actually talk about you as the person behind the professional. You must know that I have spoken to a cross-section of your colleagues, friends, and gleaned some of your insights, some of the insights, some of the things which make you tick. To start with, when I was talking to your colleagues, I really tried to push for an answer as to what gets your goat, what irritates you. And I think it was so tough, nobody could actually tell me that. So, most of the comments which came to me, the adjectives which came to me were you're a very hands-on and approachable boss, you're an amazing boss, you're a result-oriented, action-driven person, to the extent that if it is required, you can roll up your sleeves, get in the trenches and speak to people at the ground level. Which employee wouldn't love that? You're a very detailed-oriented person. You want to have an end-to-end understanding of any process or project that you pick up. I believe you're pretty sharp with numbers, and you can actually spot an error, a number error on any part of a spreadsheet, even if it is at the bottommost farthest corner. You'll actually pick it up and spot it and say that this is an error here, and this is something which is a trait which people are in awe of you about. Going by your attention to detail and your keen desire to get updated, I believe you read up to 3 newspapers a day. That's amazing, 3 newspapers a day. In this day and age of information explosion, to find time to do that is quite amazing. Not surprisingly, honestly, what ticks you off, if I can use that term, is traits of inaction. People not committing to timelines, and people who are not well read or well versed, or are not up to speed when they come and talk to you. Shallow speak, so to speak. At a personal level, you have a very strong Bong influence, a Kolkata connection. You've done your schooling from South Point School in Kolkata, and your college was St. Xavier's. In fact, till date, your friends from Kolkata constitute a very large part of your social circle, if not the entire social circle. You're a hardcore sports person. Your DNA is sports. And you play tennis, you play cricket, you play football, not surprisingly, football as well. In fact, you're part of a football club called Mumbai Pointers FC, which plays intense competitive cricket, right? And it contains of all your school and college buddies. Am I right?
Football, actually.
Football. Oh, sorry, my bad. Football. In fact, sorry, football. Your favorite cricket team is, of course, KKR. I should have mentioned that earlier. Am I right or wrong?
Yeah.
One of the things which really surprised me is you actually scaled Mount Kilimanjaro in 2016. That's amazing. Talk about fitness and endurance. And to everybody out there who thinks that you need to have a strong protein intake through non-vegetarian food, I must tell you that Saurabh is a pure vegetarian. Although he's a foodie, he likes to try out new vegetarian cuisine. But I've been told his comfort food is basically dal, chawal, and roti cooked at home. He's a very health conscious person, and he works out regularly. I think your spouse Aparijita heads audit in a large corporate, and your daughter Riddhi has just completed or given her boards last year. You're very close to your mother as well, and you make it a point to take an annual holiday with your entire family. Coming back to mountains, you're very close to you feel one with mountains. In fact, your last trip was to Shimla. Uh, One of the interesting things I got is your guiding light as a statement in life. This is something which a Hindi teacher told you years ago. कि जितना शक्कर डालोगे उतनी मिठास आएगी, which in plain speaking English means that the harder you work, the sweeter the outcome. I think that's an amazing thing. So, Saurabh, this is what I got about you. Thank you so much for being on the show. And we just dive straight into the questions. There are a lot of questions which come in. I've been told by the PMS Bazaar team, which always does an amazing job, that this time there have been over 600 registrations which have come in. That's quite amazing. I wouldn't have been surprised. I've seen a lot of audience questions come in even before the show. There are a lot of audience questions which I'm expecting during the show as well. And needless to say, there is a prize for the best question at the end of the show. So let's start off with the questions. We're talking about asset allocation. Uh, Considering the importance of asset allocation, what, according to you or what you see out there, is a typical portfolio of an ultra HNI in today's age of hyper choices?
Thank you very much, Vikaas, for the kind introduction and for inviting me to this show. And thanks to everyone on the show as well for attending the show. On the first thing that you asked me on asset allocation, I think the various studies have shown that asset allocation is the primary driver of a client's portfolio returns, whether it is in terms of the variability of return from one portfolio to another, or it is the return in the portfolio itself. Now, within asset allocation, we've seen over a period of time a traditional 60-40 composite equity bond portfolio over a period of time. That's a traditional asset allocation. However, what we've also observed over the last few years, and in fact, we just released our global market outlook for H2 2023 just a couple of hours back, is that increasingly private assets and alternate assets and various kinds of alternative strategies are increasingly part of a client portfolio, especially an HNI client portfolio. So if you look at, let's say, for example, whether if you were to look at the entire AUM globally of alternative assets, which is about 100 trillion, a couple of years back, there was a BCG report on that. Or if you were to look at even the Indian alternative markets, that's been growing at a significant pace. And that we see, especially we see that in HNI clients. So we see HNI clients having allocations between 15 to 20% from an alternative perspective. And rest of it, of course, is your traditional assets in terms of equity, bonds, etc. So that is what a portfolio asset allocation for HNI or ultra HNI clients look like increasingly. And there are various reasons for it, including what we see is that, like a year like 2022, right, where, over 150-year market history, the equity and bond, correlation broke down, where you have a non-correlated, portfolio, and you are able to hedge your portfolio against drawdowns. But both asset classes, if you were to look at a classic 60-40 composite bond portfolio, even that bond portfolio had a significant drawdown. So in that environment, increasingly non-correlated assets and private assets or even liquid alternative strategies. So those are strategies that are increasingly making sense for clients to hold, and that's how clients are positioning their portfolios.
Very interesting. You also mentioned a report which you've just released, Saurabh. Is there something? Yeah. Is it something which our viewers can access it anywhere, or is it just for private circulation?
Yes, okay. They can definitely access it. It will be available very soon on our website. It will be available on the Standard Chartered global websites as well, and I'm sure we can make that accessible to all the viewers of this call as well. If I could just talk a little bit about the report that we just released. So we call it calm. Basically, the whole philosophy is keep calm and carry on. Now there is a contradictory, little bit of a contradiction that is there. There are two schools of divergent schools of thought. One school of thought is that the US could avoid a recession, and if that's the case, then it may be a good idea to stay risk on and stay in risk assets and stay invested in equity, and go with the momentum and go with the flow. The other one is that there is a recession that is definitely going to come. It is just a matter of time, whether it's end of this year or beginning of next year. And if that's the case, stay very risk averse. Our view is that both are extremes, and our view is that you should have a more balanced approach and a more diversified portfolio approach. So we now believe that diversification will be far more important than having very focused portfolio allocations. Including, there are some changes also we've made in our portfolio, in terms of our global views. So our views is on equity is neutral, and within that we have an overweight on Asia ex Japan. We are overweight on investment grade bonds for developed markets. And for corporate bonds, we are actually overweight Asia ex Japan vis-a-vis developed markets. So we believe that there is relative value
Interesting.
both in Asia ex Japan, on equities as well as on corporate bonds. And not just Asia ex Japan, we also like Japan as well from an equity perspective. And so that's the broad sense, and there are various reasons why we think this way. One of the things that is very interesting, maybe for your viewers, is that we've not released it, but actually this is the first time. Maybe we'll give you a sneak insight into it because not released yet. But maybe in the coming week or so, we will be releasing, a structural case for Indian markets and Indian assets globally within Standard Chartered, and not particularly only on equities, but on all Indian assets. So whether it's equities, fixed income, or alternates, we believe that there is a structural case for many reasons. And maybe I could also touch upon that in the course of the coming few questions as to why we believe that there is a structural case. Specific to Indian equities, our view is that the valuations have moderated and have improved over a period of time. And so there is, if you keep the structural case in mind, that it is meaningful for clients to stay invested, and not just Indian clients. We also feel that a lot of our international clients are not adequately invested in India. Indians are and NRIs are, but not necessarily non-Indians. And that's where we feel that there is an opportunity. That's why we're making this case as well.
That's very interesting. I'm sure Madan would have a lot of questions on India. But since you mentioned Asia ex Japan, before I hand the baton over to him, I just wanted to understand, you know, uh, often we in India believe that India is the center of the universe, and there is no country which is as good as India in terms of, asset allocation or again putting your money in. But from your vantage point, purely from an emerging markets point of view, which are the other countries that you see? Say, if one has to do an asset allocation between countries, which are the other countries which you see worth investing at this point of time?
So we like Asia ex Japan and Japan as well, and we use it neutral. Within Asia ex Japan, we like China as well. China more from a perspective that we believe that H1 hasn't been very great. It hasn't been great for China, and that's for many reasons, including the ongoing US China uncertainty that is there. But we believe that the Chinese government and the stimulus that they are going to provide, plus the valuations in China are relatively inexpensive. So for some of these mix of these reasons, we are constructive on China as a market. We like that market. And obviously this is what I hear from my colleagues from Singapore, and then when they share some of their thoughts on China. As you rightly said, Vikaas, for all of us who are based in India, we feel that India is the center of the universe. I often have a discussion with my Asia and my group colleagues, and we frankly sitting here in India and looking at all the data, and that's why we made that case, right? We think India is the great destination to be invested in. However, what is also important for us is that the home bias that always is there, right, in any country, and in particular in India. And we see that in our portfolios as well, right? In terms of, if you were to look at our entire AUM that we manage for our clients, we see 95% plus of the assets that client have are in India. And that's why it's important to keep a global lens as well, and an eye out for what's happening globally as well, and which markets are attractive.
Very interesting. Madan, I'm sure you're itching to ask questions about India and the
Oh, yeah.
perspective. Please go ahead.
Thanks, Vikaas, and Saurabh, welcome to this show. Very interesting perspective you've thrown on the view of the uh, Standard Chartered on the global market as well as India. I was interested to understand, you spoke that a possibility of a recession, and also a possibility if recession does not happen, how the clients really manage and have a balanced portfolio. But per se, what is the Standard Chartered Global's view about the recession itself? Because this is an area where current data looks pretty good, but obviously the interest rates are very high. Obviously, somewhere at some point it's going to hurt the growth rate in these developed markets. So, what is their view per se on that? Is it a recession biased, or is it's still a very balanced sort of a view?
No, our view is quite clear that there is a high likelihood of a US recession. We expect that US recession to happen next year. And there are various, the only thing we feel that this year, first, there will be a couple of rate hikes. That is what is getting indicated. However, we also feel that what Fed is indicating right now on the pause and the subsequent rate cuts, they will actually happen sooner than what they are indicating. With that happening, we also believe that the yields that you see today, the long-term, yields that you see today, especially in the US, and 12 months from now are not going to be where they are. And that's where we feel that there is an opportunity for clients to invest in investment grade bonds, and government bonds, high quality bonds, vis-a-vis cash, because not only will there be carry, but you will also have, those yields come off as well, leading to capital appreciation. So those are the thoughts that we have from a US market perspective. Including, we have seen that across the board as well, right? Across, I think we have seen many central bankers have at least some. I was looking at the data. At least 7-8 of them have raised rates. So everyone's been very hawkish across, especially outside of Asia, if you see all the markets.
So to rephrase it and put it in a simple manner, you are saying there is a bit of hawkishness that has come in, but still feel that rate cuts are somewhere down the line, and it will be much different than the trajectory that currently being projected by most of what yields particularly speak about. That's what is.
Yes.
Very much.
Also, what we feel, there could be a little bit of a momentum play right now that is there for the next few months.
Very much echoes what internally we are thinking about it, because people ask us about 2024 yields. We say it's too far, and I think you need not be. You should be actually not taking it too serious at this point of time. Things can change dramatically, is what.
Yeah.
That's a good to see. On the India equity side, I was you mentioned that the valuation the only concern, because obviously the earnings growth has been pretty strong in India compared to many other economies, and outlook also looks very strong. Are you worried that this high interest rate scenario in India will bring down the growth at some point of time as an equity outlook, and that is the reason why going neutral on India equities?
So see, we are not concerned. We are not unduly worried about a high inflation environment. I think we just had the MPC, and we believe our central bank has managed inflation and rates spectacularly well, right? The kind of environment that we are in. I think we are amongst the very few countries in the world where there is very nice real return that you have. And however, see, the concern is, I won't say it's a concern. We believe that India is relatively always going to be expensive vis-a-vis other markets, right? Historically, there is a premium. I think the premium may be about 30-35%. The premium had shot up to about 90-95%. The premium could be about 60-odd%. we are not really, we think that the valuation at best is about one standard deviation. Or let's say, for example, if you were to look at Nifty 50, it could be about 18.5 1 year forward vis-a-vis, let's say, long-term averages of about 17. With that being the case, however, we feel that that is not really something that clients should be unduly concerned about and stay away from Indian equity assets. There are a host of reasons for that. If I could just mention some of them to you. One is that we believe that there will be this entire next decade, or this decade is where this whole cycle of India becoming a middle income country from $2,600 of per capita, that is something that we see going up. Secondly, we feel that this whole demographic dividend in terms of the number of people that will come into the workforce in India, that is going to be 1/4 of the total number of people going to get added in the workforce globally. Now, that's a big demographic dividend for the country. We believe the digital infrastructure that has been put in place and the rewards of that we are seeing. The reforms and policies, including in particular, we are very excited about the various schemes by the government on revival of investment, the investment cycle revival, and we see that as a big positive. We see a lot of I think the macro positives everyone on the call must be aware of, right? GDP growth, we don't have any concern at all. We are very, very constructive on that. One other area where we are very we feel that India is clearly a beneficiary is that the fact that it will increasingly become a multipolar world, and that's where India will be a beneficiary. With this supply chain, people will want to actually manage their supply chains far better than the current concentrated supply chains, and India is going to be a beneficiary of that as well.
Great. Thanks, Saurabh, for taking my question. Over to you, Vikaas.
Thanks for that. I was listening very keenly, Saurabh, when you were talking, and you talked about the per capita income shifting and investor preferences shifting. We've just released a report, recently, which talks about the fact that very nearly if a country crosses $2,000 per capita income, you tend to have changing levels of consumption, investments, etc. But there have been a few countries which have actually moved to becoming an economic superpower. The US for one, China for another, and there has been, for lack of a better term, a USP, which has actually gone out there. India, probably after several false starts, is on its way to become an economic superpower. And probably the vision which we're exporting to the world in terms of a USP is low-cost tech solutions. I mean, there's a lot of noise around a lot of things, which is absolutely right. But our USP seems to be low-cost tech solutions. And if that is indeed the case, then I think everything in terms of valuations or earnings needs to be looked at from the perspective of not just growth, but becoming an economic superpower. So that's something which our viewers can actually look up in our website as well. But coming back to geographies and the impact of cultural and social factors, very interestingly, we keep hearing that investors actually have a lot of cultural and social biases when they make asset allocation, when they make investments. How do investors assess the impact of cultural and social factors on investment opportunities in different regions? Are there specific considerations related to cultural differences that influence these asset allocation discussions?
Yeah, I think we ourselves have seen this at least. So I'll give you a couple of perspectives on this. One is globally the way we see it at Standard Chartered. We feel that we definitely feel that there are biases, cultural biases, including we feel that there are biases even when you run an investment committee. Like, for example, we have something called the Global Investment Committee, and we have a process whereby we vote and we decide on what our views are globally. What we've believed in firmly, and that's played out well for us over a period of time, is that as against individual single person expertise, we feel that there is collective diversity is a far stronger driver of good performance in let's say, for example, investment decisions. Because we have, just to give an example, we have people from 10 different nationalities in our GIC globally, and that really leads to a lot of diversity of thought and so on. Even when it comes to, for example, individual clients investing, we've seen traditionally there have been a lot of biases, right? We have seen a lot of biases on, for example, at least in our country, we've seen a lot of cultural bias on gold historically. We've seen some bias on real estate as well, although that's definitely shifting. What is also happening is that there's increased awareness of other asset classes, of financialization of savings and alternative assets, and how that can drive portfolio returns, and how it can non-correlated investments can drive portfolio returns. So those are very different. And when we see, let's say, in a developed market, clients invest very differently. They are very happy to take risk assets, alternative assets, but they are very they are very rule based, very organized. The way we see, the way they look at the world culturally is very different from the way Asians, if I were to just do a broad sweep, right, look at it. And we are more used to, let's say, chaos, and we are more used to disorder, and like in India, we are more used to jugaad, right? So the way we look at things is very different. But I think there is also an evolution. So there are maybe a couple of things here. One is the cultural biases, but also the way, let's say, for example, for a market evolves, right? High inflation leads to particular asset classes doing very well. And we have seen with that changing over the last decade or so, we have seen a lot of other asset classes come to the fore, which hitherto were not the case, right? If you're going to get 15, 16% in an FD, or let's say very high inflation will drive different kind of, investor behavior. And let's say, because then you are trying to just protect the value of your wealth.
Interesting. One interesting fact I can just tell you, there was a survey done recently in terms of number of investors, number of ultra HNIs having an exposure to alternate investment funds as a category. It's expected that currently from around 5%, it will increase to 15%. And the number of ultra HNIs is expected to grow by 40%. Ultra HNIs being clients stroke family offices who have portfolios of 30 crores plus. So that's a very interesting thing. And I think that is also driving a lot of, they're feeding into this capital hunger, which is also starting to emanate. But good point. Talking about reports again, Saurabh, I will just pick you up on your wealth expectancy report, the Standard Chartered 2022 wealth expectancy report, in which I think there was a statement which talked about at least 50% of the clients indicating a preference towards investments which are more ESG oriented. Okay. How has this actually panned out in terms of your asset allocation strategies, or clients looking at certain investment avenues? Would you be able to throw some light on that?
Yeah, sure. So see, the way it is worked is that when we did this survey last year, and we came out with this report towards the end of last year. So we released this report actually December of last year. And when we did this survey, we saw that a little over 50% of the clients said that they will increase their ESG investments in 2023. In India, that number was slightly higher. It was actually 60%. But what we've seen in even ESG, we have seen a few things from an ESG perspective. One, we have seen, I think, India as a market, if you see, let's say, end of 2020 and the first half of 2021, we saw a spate of ESG. I think put together we have about 8, 9, or 10 such funds available in India. The total AUM of this was about 10,000-11,000 crores even by June 2021, but we've not really seen that translate. We've not seen that translate even now. I think the AUM is broadly around the same number. It's not really grown. There are many reasons for it, right? One of the reasons is that, if you see the performance of some of these products, right, very few of them have beaten BSE 100. Only one beat in the last 1 year. Right? So 3 years also, hardly anyone has beaten that. So while some of the product where so at a house level, we are very constructive, and we believe that there's a couple of long-term themes at play here. One is the entire, energy transition theme, to renewable energy and green energy. And the other theme is on water and water conservation and water-related theme.
Yes.
We had launched a product. The product did well as well. It's a global product. It's a BNP product. We launched that product. But so in absolute sense, it is done globally. It is done well, right? But if you look at it in the context of, let's say, Indian equity market, BSE 500 return, it would not have performed as well as that. So relative performance also has, and that, right? There is a little bit of a recency bias. A lot of stocks, or let's say a lot of the parts of the market that have done well in the last year and a half or so, may not necessarily have been, right on the top of the ESG. But the way we think is slightly different. We feel that we see a big difference between, let's say, the clients who are, and that survey threw that out, right? Through that data, is there people who are about in their 50s and beyond, and people who are in their 18 to 35 age range. We see increasing awareness of ESG investments, and they are far more likely to do ESG investments, or maybe look at ESG being one of the filters or screener when they invest. Also, we see a lot of asset management companies start using ESG as a screener. At least when we talk to them, they tell us about how they look at ESG. I think for us, in various ways, for us to longer term to be able to look at from a planet perspective, these themes it is very nascent now, but it will build out. In India, it is more nascent than it is globally.
Interesting. So I completely concur with you. And when you're talking about themes, I think Madan will have a few views on his own. But one of the things I realized what ESG has done, it has sharpened the focus on G. More and more companies are now aware that if the G part is taken care of, and even if it is perception and maybe closer to reality or may not be closer to reality, I think it starts reflecting in terms of the valuations. So that has definitely been a positive spin-off, which I have seen over the last few years, especially in the mid and small cap stocks. So
No, you're spot on, Vikaas. I think you made a very good point. In India, governance is something that we've seen play out very favorably or unfavorably for companies as well, in terms of, yeah.
Madan,
you talked about ESG, and there is one more very hot topic globally, AI. I'm not referring to America and India. I'm referring to the artificial intelligence. What is the Standard Chartered House view on the generative AI in the financial services space? How it can disrupt, particularly the wealth management? Any view on that?
So I'll break it into two parts, okay? And I am a self-confessed, someone who's challenged technologically. So I'll give you a limited market view, and then I'll give you maybe a little bit of a technology view from a wealth management perspective, because that's something we've seen a lot of, right?
Yeah.
So we like the AI, theme, in particular in the US, right? So that's something that we like, and if you even our report has a reference to that. But I think what I would like to talk a little bit more about is the application of, we see how technology is driving wealth management, or how the clients invest their money. I think, and we have seen massive change here, right? And a lot of that has been driven by, our government, our regulator, and the kind of technology stack that is made available. Is your question referring to that, Madan? Because that's something that maybe I would like to touch upon.
No,
Yeah.
My question is on when I read about this generative AI space and how it can disrupt many sectors. A lot of talk about the chatbots kind of transforming work in the financial, the wealth management space, consulting space. So what is the view?
Okay. So our view is that, see, managing money, either, let's say, Madan, you as a fund manager, when you manage someone's money, or let's say when we are advising a client on their investments, I think it's a lot of it is about trust, right? It's very difficult for a chatbot to replace it. So that's not really our view at all. Our view, however, is that increasingly clients who earlier, like, just to take the example of any asset, let's say, for example, an alternative asset, or clients earlier could only have access to advice when you are larger and larger, right? An HNI client has it, but a smaller client doesn't have access to good advice, right? Because advice is expensive, because there is someone who's skilled who has to provide that advice. We feel technology can be a big game changer. It can democratize advice. So I can advise a client for a much smaller portfolio, almost the same quality of advice, right, using technology. And there's a lot of work we are doing in that space.
Okay.
Leave aside the basics on, for example, obviously the entire client onboarding, then the client transaction. We have launched something called My RM, where a client can have an interaction with the RMs in our organization in a very secure manner, the portfolio reporting, etc. But I think what we are even more excited about, is the whole, being able to review a client's portfolio and then being able to give advice on that portfolio. through the use of data and machine learning, and then
Okay.
recommend a portfolio where either they can reduce risk or improve return, or preferably both.
Sure. So definitely the adoption of technology from an advisory point of view is there, but it has not yet reached the point of chatbot replacing a wealth manager. It looks like. So on the there is this when you look at the alternate space, there is this worry about the illiquidity comes to the investor's mind. And so, what is the when you advise the clients, how is this aspect taken into consideration?
Yeah. So see the key tenets of forming of a portfolio or going about constructing an investment portfolio for a client will be on asset allocation and diversification, right? When you do asset allocation and when you diversification, and in fact in our calm strategy, that the H2 outlook that I spoke about, allocating broadly is a big part of our theme, right? Allocating across asset classes. We feel that one of the ways in which clients can reduce volatility in their portfolio is by allocating to private assets or to alternative assets, including to liquid alternatives, hedge funds. There are various other alternative assets, right? Whether it's PE, VC, etc., or credit. We think performing credit, I think, is a great space, especially with the changes that have happened in the debt mutual fund. Taxation, we feel that it just makes the entire playing field level, right? And you're going to evaluate products more on pre-tax than on post-tax. But instead of digressing, coming back to the point, we feel that the correlation is much lower, and by adding portfolio alternatives to your portfolio, you can improve the return and reduce the risk. And that's the data that we've seen. Just to give you an example, in a year like 2022, when both equity and bonds did poorly, actually, you were to see let's say a composite alternatives basket that we would have offered globally, that has given slightly marginally positive return. Or even if you see some of the other products that are available, at best they have been marginally negative. So you can reduce your risk sharply, reduce your correlation sharply, and improve your return. So even if you see the track record of Cat 1, Cat 2 products or Cat 3 products in India over the last few years, they have delivered alpha. Now, some of this is something that you have to, illiquidity is something which is the nature of an alternative product. Not in every product, but some of them, right? Let's say a liquid alternative like a long short product is not really very illiquid, but some of the products are. The risk range and the liquidity range is a spectrum. So the way we would look at it is that a client will build a foundational portfolio and an opportunistic portfolio. In the portfolio, in line with the client's goals, the time horizon they're looking at, what is it that the liquidity that they're looking at? Liquidity is a price you will pay only when you will not pay a price of liquidity if you're not going to get superior return as an investor, right? Now, for that to happen, at the same time, at a portfolio level, you're not going to put a very large part of your portfolio completely illiquid. So there is a balance, again, there is to strike. So it's a conversation between a client and the person who's advising the client on the allocation. We feel something like 20-25% at best, between 15 to 25% is a very good, and we've seen in our report, in fact, we published it today, that it improves our return by about 60-70 basis points at a portfolio level if you have allocations to alternatives.
Thanks, Saurabh. Really, thank you so much.
Interesting. Saurabh, you mentioned something, I just missed that. Foundation portfolio and opportunistic portfolio. This is what you said?
Yes.
I just missed that.
Yeah.
Very interesting.
So we use the same, a lot of people use core satellite. We use foundation and opportunistic. So that's the same thing basically.
No, but it's a nice way to put it, just if I'm a client, I'm listening into you, it just gives me an idea of where you're going with this, foundation and opportunistic. Anyway, so I have one last question before we move on to the audience questions. The audience questions have started coming in. And this question is slightly more contemporary, if I can put it that way. There is this whole segment of new age HNIs which is just coming. You could probably classify HNIs or ultra HNIs between new age and vintage. Okay, just to draw perspective. So how do new age HNIs approach alternative investments? We keep hearing stuff like cryptocurrencies, venture capital, fintech startups. So what is the sort of difference in thought process, risk appetite, asset allocation that you see from your perspective in these clients?
So we see, in a lot of cases, we see a marked difference between how a traditional HNI investor who's been investing for some time vis-a-vis, let's say, a new age HNI or on an entrepreneur or a startup entrepreneur who's an HNI and is investing. So we see clearly we see a couple of significant differences. One, we see the risk appetite is definitely different, right? The outlook on the investment portfolio itself is very different. Secondly, what we feel that they are far better informed in terms of the kind of investment avenues and opportunities available, including on alternatives. They are more open to investing in PE or VC products, and they themselves do that in their own capacity as well. We see some of that, but at the same time, they appreciate that a lot of the money that the wealth that they have created needs to be preserved as well. So again, they understand and they appreciate asset allocation as well far better. So while they look at alternatives and they look at sometimes illiquid alternatives as well, including investing in PE or VC, depending which stage, depending on the stage and so on, those kind of products. But they are willing to, they're willing to take that risk, and they look at it, do it at a holistic portfolio level. I think that's the good part about approaching it that way.
Very interesting that you mentioned this. I had a chance to speak to a startup founder who had sold off his business, or a majority stake, and I had obviously gone to him with a traditional set of investment products just to talk with him. And he says, Vikaas, very young guy, he told me a very interesting thing. He says, I don't want to do anything just for myself. I want to do it for the ecosystem which has given me so much of money. So I would rather plow it back and give it to other founders so that we create much more wealth. I was astounded by the perspective. So I guess this is something which is, again, so thank you for that. And audience questions seem to be coming in, and I'm just going to take some of them. Sort of along the line, you'll have to just keep in mind that there is a prize for the best question. So if you like something, please ping it. Okay.
Yeah, sure.
Okay. I think you mentioned something about an RM's expertise somewhere along. I think Sudhakar Bontala is talking about asset allocation being a fine art. It needs fine balance between equity, debt, gold, and other tangible assets. And each and every HNI has differentiated needs. Can we say a dedicated fund manager with investor inputs can do a really great job? What he's talking about is mass customization here.
So, honestly, the jury is still out. But we have, there are model portfolios that one can create and one does create, right? And depending on the risk profile, so you could have, let's say, a few different risk profiles and different model portfolios. But I think it's always good to have a conversation with a client, especially if it's, and the client should be willing to, depending on what the client wants, whether it's a client who's availing advisory or distribution, should be willing to pay the price for that advice, which can then help them. Otherwise, off-the-shelf products are available. Like what we've done is, just to give you an example, depending on the risk profile, at Standard Chartered, we have created these packs. So you come in and let's say you're a moderate risk investor and you want to invest either a lump sum or SIP, or let's say you want to do an STP. We have enabled all of that technologically, and we will allow you to invest, and we will show you our recommended products for your risk profile that work and for your goals. So that's the way we try and stitch it. But I think a lot of times, I think it may be, if once you start putting substantial sums of money and it's important for you and your family, it may be a good idea to have a conversation with someone in whichever organization you're using and they're availing their services.
I would actually second that. I've seen a tendency amongst the ultra HNI to actually seek out advice from a variety of people rather than just going by what is available on the shelf. And I think you mentioned something about a My RM program at Stancy. Right?
Yes.
So that's something which people can engage with, which are RMs, and get some maybe quote unquote customized advice in terms of what their actual risk profile is, rather than. Am I right? That is the way it is.
Yeah. So we would, my RM is more of a tech solution, which basically connects, is like an umbilical cord between a priority client and their RM. And it creates an ecosystem where the client in a secure manner can share data, can share, let's say, for example, documents and can do transactions, and the client need not do a transaction. The client can, the RM will create, after a discussion, the RM can create a proposal, let's say make an order, and the client can just review and say, okay, that's one part. The other part is that we have an ecosystem where we have specialists who are investment specialists. So we call them wealth specialists, who are assigned to RMs as well, and they work with priority clients. And they meet, let's say, for example, they would speak to a client, depending whether they're digitally or physically, and they will create, help the client create their investment allocation across products. And we also have a process on fund selection and product selection and our house views. So we have house views as well on themes that we like. For example, just to give an example, we like financials in India, so we are very overweight on that. So we will recommend products in a portfolio which will reflect our house views as well. So we'll try and translate our views into solutions or products that should be there in the client portfolio.
Interesting. There's a question from an anonymous attendee. Kindly put your names, otherwise we can't really reach out to you. And which is, they've asked, this person has asked about the US recession, China market, India market. I think you already answered that. Rishabh Shah is asking about what he's calling as currency wars. There is a narrative of de-dollarization, and how will central banks approach it? Consequently, is gold an attractive asset class?
Yeah, that's a great question. Actually, there is a lot of I would say it is a very nuanced answer. It's not a binary answer. In fact, we were overweight gold, and we've just reduced our weight to a neutral weight on gold. We believe that gold is a very, very good portfolio hedge or a portfolio diversifier, right? You need to have a gold allocation more from that perspective. But the narrative, the way it's playing out, is that we feel that first, the US will first raise rates. So I'll take the gold question, then I'll also cover the de-dollarization, right? So first, the US will raise rates before they cut rates. So normally we have seen that, if in a rising rate environment, gold is not necessarily, going to do well at that point in time. At the same time, there are many other things that are at play. There's a lot of conflict. So there could also be, gold is still a safe haven asset class. So that could happen, right? And there is a lot of geopolitical tension. There's a lot of demand. Even central banks want to shore up their gold reserves. And we've seen a lot of demand last year as well for that. So it's not a straight answer. You can't be completely out of gold, but you don't want to be investing in gold from a perspective that, you're going to get great return from here, and that's why you're investing in gold. So that's not our house view. Our house view is not that you should be investing in gold purely from a return perspective, but as a safe haven and as a hedge. Definitely gold should be there in the portfolio. Also, we see that gold, actually, if you see from 1970 onwards, in dollar terms, gold has given 3.3% return. But if you see in INR terms, gold has given 8.8%. So actually, INR return for gold has been far better. There's almost a 4.5% element of rupee depreciating over long periods of time versus the dollar. And that's why that gain. But our 12-month out view on dollar, rupee, or let's say 24-month view is not that, let's say 12-month out view is not that dollar will further strengthen from here. That being the case, you should not appreciate gains because, and gold is a great way for you to have dollar asset, right, in your portfolio. That's true global diversification, because gold is going to move that way. However, on the de-dollarization, slightly different view. There is a lot that has been spoken about it, but we feel that it is. See, everyone will try. All the central banks are very keen to do settled trades not in US dollars, and challenge the hegemony of the US dollar as a currency of the world. But I think it is going to take time. It is very slow, gradual, and very nascent right now for us to say that dollar is not going to be king and not going to be the primary currency of the world.
Interesting. I would just add a bit of heft to what you're saying. As much as we think that Indians have a lot of gold, but in most HNI, ultra HNI portfolios, I have not seen too much of weightage to gold. So it may not be a bad idea to actually increase a little bit of asset allocation to gold, considering what you've just said, but only up to a point, not up to what is generally prevalent. I think it's an excellent answer.
So we recommend 5 to 10% allocation to gold that's the range in which we recommend an allocation to.
Perfect. Sarthak Patel asks a question about the alternatives market in India being at a more nascent stage as compared to the global markets. And how do you see this market evolving in India? Can we reach at all the developed market levels in coming decades?
Yeah,
Considering
so
regulation. So sorry, that's the undercurrent. Considering regulation.
no, I
Considering
would say,
regulation.
yeah, I would say that the regulation is, and see, honestly, because you are the expert here because you run an alternates asset management firm. But I'll maybe chip in, and then you could add on your perspective. I think our regulator has created a great ecosystem across various categories of AIFs, right? So that are there, and they are highly regulated. I think the other good thing that has happened is that there's a lot of benchmarking on these AIF products that is also
Yes.
done now by the industry. We feel that that transparency of portfolio benchmarking, return benchmarking is very important for clients to be able to invest and evaluate where to invest, right? So we feel that's a big positive. Also, in line with our structural India story, what we've also seen is that Indian alternative asset or PE or VC asset, we have seen that grow by 5 times over the last decade. We've seen the number of investors grow by 4 times, and we've seen our share of these assets grow from 15% at the Asia Pacific level to now 20%. So India is a great destination in terms of these investments, and we feel that there is the path ahead is very bright, and there is no reason for us to feel otherwise. Obviously, the scale that we have in terms of the size of our market globally is $100 trillion market, right? It'll take us time, but the rate of growth we will have already, the rate of growth I think we have is 2x that of, let's say, more traditional assets like mutual funds and alternates, right?
Absolutely. And since you asked me about regulation, I think our view at an industry level is also the fact that a lot of innovation is being encouraged. What SEBI is trying to do, or the regulators are trying to do, is create a proper sandbox, so that everything is in a controlled environment, does well, and then you could probably scale it up. So I think it's working fairly well right now. And most of us come in from the mutual fund industry, and we've seen regulation develop over a few years. So by keeping that in mind, we also know what is permissible, what is not permissible. But I think there is a lot of innovation expected here, and I think that should again propel the growth of this entire industry. There's a question which is coming in from Sampath. He's asked me this question 2 times already, and I think it merits attention here. He's talking about quantum computing startups. Okay, what is your view on quantum computing startup? Do you think quantum computing is the way forward? Goldman Sachs is partnering with LongQ and QC, and earlier he asked about what is the view of Standard Chartered on utilizing quantum computing in wealth management? Honestly, I'm a little out of my depth in terms of quantum computing, so I just asking you, do you have any view on that?
See, honestly, I don't fully understand what is quantum computing, but I can tell you this much, that we have a very, very, favorable view in terms of using technology, including using, machine learning or data for being able to help clients take investment decisions or let's say create model portfolios or evaluate client portfolios. And but I'm not sure if that is the exact question that is being asked.
Correct. I know where he's going with this, but I think probably that's a separate forum we would need to answer. Some
Okay.
questions are coming in directly for Standard Chartered. There's this person called Daya T who's asking about knowing about more about model portfolios where you invest only in index like country index or sectoral index funds. Would it be okay with you if you can just forward these questions to your team and they could probably take it up and answer
Yeah,
directly?
sure. We can do that. Absolutely.
Last couple of questions in the interest of time. Somebody's asking about outlook on real estate in Dubai.
I'm out of my depth on that one.
So Rahul, I'm just going to tell you that if you go to Dubai today, if you stand in the middle of the road, you feel like you're in Bombay. It's a completely the chaos and everything else is turning out to be exactly like Bombay. It's a very high energy city. Maybe we can take this up separately. I have my own views on that, and I can talk to you about that. And Yeah, I think this is something which is the last question I'll talk about. Do you think increase in LRS investments will help more investment diversification option? And the second part, Mahindra is asking this question: do you think government or private sectors can look at more startups in cybercrime, AI, quantum computing? Again, quantum computing.
So clearly, I
LRS.
have to brush up on my knowledge of quantum
No,
computing.
this is LRS investment limit. He's talking more about LRS investment limit. Let me just stick to that. Do you think an increase in LRS investment limits helps more in investment diversification options? Last question, promise.
Yeah. So thanks, Vikaas. So see, clearly LRS is a great avenue that the government has given to all of us as resident Indians, right? And but it's a very healthy limit. It's a USD $250,000 per person limit. So in a family of, let's say, 4 people, you could pretty much do $1 million a year. Also, there are other ways in which you can do it. Right now, I don't think the feeder fund option is available because the $7 billion limit is already exhausted. And then there is another additional $1 billion through the ETF route. And also the GIFT City promises to be exciting, but again, that will be through the LRS route as well. But there is a lot of action there as well, with a lot of financial institutions across banks, asset management companies, and I know even an life insurance company that has set it up. So there are a lot of products that will be available for, including we are trying to do a product. I must mention this to you guys. One of the things we feel that international diversification in portfolios, like I did mention a while back, that we see a fair amount of home bias. And we feel that it's not just because the clients don't want to diversify. We also feel that it is because the inability of the client to have continued access to information and understanding of investment that you are making outside your home country, being able to track that investment and take decisions to enter a product or, let's say, exit a product. So we are, in fact, we have a global product across risk profiles called a CIO signature fund, which helps you basically replicate our house, where we replicate our house views through a DPMS, discretionary. Basically, it's a discretionary product where it will asset allocate across funds and ETFs, and clients can then take advantage of that, and they just buy that one product, and then we provide advice on that, and we manage that portfolio. We outsource it to an asset management company, and then we do that. We are trying to bring that product to India as well. And if we can bring that product where it does not require an LRS, and we can do it, the client can do an INR investment, and then in return, it gives you global diversification and global asset allocation and, and SCB house views. So that's something that we are trying to do. Hopefully we will be successful in that and bring that.
So that's the CIO signature fund which you're looking at getting. That's interesting. I'm sure a lot of viewers would be interested in knowing as and when it's launched.
Yes.
Wonderful. So I think we had a very animated discussion when it came to this question on currency wars and gold and de-dollarization. I think Rishabh Shah has asked, if it's okay with you, should we just give him the prize for the best question?
Yeah, I think it's a great question, and it's a question from someone who's clearly very knowledgeable and very well informed to ask a question like that.
Yeah.
So he deserves this award.
Absolutely. And talking about knowledgeable and well-informed, I think while you were talking, I was making several notes. You would have realized I'm asking you a few follow-up questions as well. I think thank you so much for being here. Your knowledge, your insights, your perspectives have been very useful. I've been listening with a lot of great intent, and I think I speak for all our viewers. This has been a fascinating session, a very crisp, concise, focused discussion on a lot of topics. Asset allocation is not usually easy to discuss and debate and outline, but I think you've simplified this in the best possible manner. So thank you so much, Saurabh. This was really, very interesting.
Thank you very much, Vikaas. I think you run a wonderful, alternates. You run this property so well. I've seen some of the illustrious speakers in the earlier session. So thank you very much for inviting me. Thanks to you and Madan and the PMS Bazaar team, and to Akshara. Thank you.
Thank you, sir.
Thank you so much.
And thank you all for for this Friday evening and giving us for a wonderful session on HNI, global asset allocation, global macros, and about de-dollarization. A lot to carry home today. So thank you. Thank you.